Henry is sitting at his kitchen table on a Sunday morning. He has two loan estimates in front of him. Both are for the same house, the same lender, the same down payment. The only difference is the term. One says $2,536 a month. The other says $30,047 a month. And every piece of financial advice he has ever received is telling him the higher number is the smarter choice. If you are buying a home right now and you are staring at that same decision, this is not a math problem. It is a behavior problem, and the answer depends entirely on something no mortgage broker will ever ask you. If you are a 30 to 50-year-old home buyer with income that is not perfectly predictable, this is not a discipline problem. It is an architecture problem, and the architecture has two very different shapes. I want to be honest with you up front. There's no universal winner here. Both sides have a real case. What I can do is show you the math behind each path, show you where each argument breaks down, and give you the one question that actually resolves it. The case for the 15-year mortgage is not hard to make. In fact, it is the strongest possible version of the responsible borrower argument, so let us give it the full treatment it deserves. At current Freddie Mac rates, a 30-year mortgage sits at 6.53%. The 15-year sits at 5.87%. That 0.66 point spread is the first gift. On a $400,000 loan here is what that looks like. The 30-year runs you roughly $2,500 a month. The 15-year runs you roughly $3,350 a month. So yes, you are paying about $810 more every month. But here's what that discipline buys you. Over the life of the loan, the 15-year costs about $202,000 in total interest. The 30-year costs roughly $513,000. The gap between those two numbers is $310,000. That is not a rounding error. That is a full renovation budget. That is a college fund. That is a decade of retirement contributions. Gone, paid to a lender in exchange for the comfort of a lower monthly payment. Picture two bars sitting side by side. The left bar is the 15-year interest cost. It reaches about 2/3 of the way up. The right bar is the 30-year interest cost. It towers over the left bar by more than $300,000. Same house, same purchase price, same down payment. The only variable is how long you took to pay it back. That bar on the right is what patience costs you when it is applied to a debt instead of an asset. If you want more breakdowns where we run the actual numbers instead of the conventional wisdom, subscribe to Salary to Strategy. Now let us look at what each side is really arguing. There's a second argument for the 15-year that goes beyond math. It is the forced savings argument, what I call the forced savings mechanism. When you sign a 15-year mortgage, you are making a legal commitment to build equity fast. You have no choice. Every month, a larger share of that payment is going to principal, not interest. You are being compelled by contract to pay down the debt. There is real power in that. Most people left to their own devices will not be disciplined with the difference. They will tell themselves they are saving it, and then spend it on something else. The 15-year eliminates that option entirely. That is not a character flaw. That is how humans behave with discretionary money. The 15-year takes discretion out of the equation. Here's what a financial planner who loves the 15-year would tell you. After 15 years, your mortgage is gone. You own the house outright. You suddenly have an extra $350 a month that used to go to a lender. Now it goes wherever you want. That cash flow in your mid-40s or early 50s is a genuinely different life. You can max out retirement accounts, pay for college, work part-time, start a business. The psychological value of no mortgage is not nothing. It is real and it is powerful. So that is the strongest case for the 15-year. I want you to hold it firmly in mind before I complicate it. And there is one more thing worth saying in the 15-year's defense, because critics of this choice often underestimate it. The 15-year works even if the market crashes. The interest savings of $310,000 are locked in by the amortization schedule. They do not require the stock market to cooperate. They do not require discipline. They do not require you to stay the course when your portfolio drops 30% and every instinct you have is telling you to sell. The guarantee is the product. When you sign a 15-year note, you know exactly what you are getting. That certainty is worth something. Not everyone who says they will invest the difference actually has the stomach to watch $200,000 become $140,000 on paper and hold steady. The 15-year removes that psychological gauntlet entirely. I also want to briefly mention a third path that does not get enough attention. You can take the 30-year and voluntarily overpay each month whenever your cash flow allows. You get the lower mandatory floor of the 30-year, and you get the faster equity build of the 15-year whenever you choose to apply it. Most lenders accept extra principal payments at any time with no penalty. This is not a perfect hybrid. Overpaying requires sustained discipline in the same way investing requires it, but it does give you more levers. You are not locked into the higher payment, and you can accelerate payoff in good years and pull back in lean ones. It is worth knowing that option exists before you commit to either fixed term. Here is what the 15-year advocates almost never mention. The $1810 monthly gap is not just a number, it is a mandatory obligation. Every single month, regardless of what happens in your life, the 15-year demands $3,350, not $3,000. Not $2,800, $3,350. And the world is not always cooperative. Think about what that means in practice. Henry has been in his house for 4 years. He gets laid off in a downturn. He is not panicking yet. He has some savings. But average unemployment spells today run about 3 to 4 months. Some run longer. During that time, he has a fixed monthly commitment. The 30-year borrower in the same situation needs to cover $2,500. Henry needs to cover $3,350. That is an extra $810 every month. Over 6 months, that is nearly $5,000 more in mandatory cash outflow just to keep the roof over his head. In a crisis, that gap is not abstract. It is the difference between staying current and missing a payment. The 15-year does not care about your layoff. The contract does not have a hardship clause. And there is a second crack in the 15-year argument. The forced savings case assumes that equity is the best place for your money. But equity in your home is not liquid. You cannot pay your electric bill with it. If you have $200,000 of equity in your walls and $400 in your checking account, you are not financially comfortable. You are asset rich and cash poor. Locking money into a house via accelerated principal payments is not the same as building a liquid investment portfolio. One you can spend in an emergency, the other requires a sale or a loan to access. Now here's the twist. And this is where most comparisons skip the uncomfortable part. If the 30-year borrower actually takes that $810 monthly gap and invests it every single month in a diversified index fund, the math changes significantly. The S&P 500 has returned roughly 7% annually in real terms over the past 30 years after inflation, and with dividends reinvested. At that rate, $810 a month invested over 30 years grows to just under $990,000 nominal. After a 15% long-term capital gains tax, you are looking at roughly $840,000. That is not the interest savings of $310,000 that the 15-year offers. That is nearly 3 times as much. The 30-year borrower who invests the gap does not just break even. They come out substantially ahead on total wealth. Let me put that on a graph. Imagine 2 lines starting at the same point. The 15-year line climbs steadily by paying down debt and building equity fast. The 30-year invests, the gap line grows slowly at first, then accelerates as compounding kicks in. By year 20, the lines are neck and neck. By year 25, the 30-year line pulls ahead. By year 30, it is sitting more than $500,000 higher, not because the 30-year borrower was smarter, because they put the same dollars to work in an asset that compounds faster than a debt that declines. This is what I call the flexibility premium. The 30-year mortgage does not just buy you a lower payment, it buys you the option to do something with the difference. You can invest it, you can keep it liquid for an emergency. You can deploy it when opportunity appears. You can cover a layoff without touching savings. The 15-year takes that option away in exchange for a guaranteed $310,000 in interest savings. Whether that trade is worth it depends on what you do with the option. And that is the problem. The Invest the Gap scenario has a very large condition buried inside it. You have to actually invest the gap every month for 30 years without touching it, without spending it on a vacation or a car upgrade or kitchen renovation, without panicking and pulling it out when the market drops 30%. That discipline requirement is real. Most people will tell you they will do it. Fewer will follow through consistently for 3 decades. Here is how I think about it honestly. The 15-year is a better deal for people who know they will not invest the difference. If that $8-10 is going to drift into lifestyle spending, the 15-year forces the wealth building that would otherwise not happen. You are paying a fee, your higher interest cost, in exchange for being locked into a productive behavior. That fee might be worth it. The 30-year is a better deal for people who will genuinely put the gap to work and who have income uncertainty they need to protect against. If you are a freelancer, a salesperson on commission, a business owner with irregular cash flow, or someone in a volatile industry, the lower mandatory payment is not just comfort. It is liquidity insurance. Your floor is lower. The margin between your minimum payment and your income can absorb more disruption. And if you invest the gap consistently, you end up with more total wealth. So here is the protocol. 3 steps, each one executable this week. Step 1 is to calculate your discipline score, not your intention. Your history. Look at the last 24 months. When you received a raise, a bonus, a tax refund, or any windfall, how much of it actually went to savings or investments? Be honest. If the answer is most of it, you are a candidate for the 30-year Invest the Gap path. If the answer is almost none of it, take the 15-year and let the contract do the work. Your track record with past money is the best predictor of what you will do with the gap. Step 2 is to stress test your floor. Take your monthly income, subtract your minimum fixed obligations, and ask what happens if that income drops by 30% for 6 months. If the 15-year payment does not fit in that scenario without severe strain, you are taking on liquidity risk that may not be worth the interest savings. Lower the floor. Give yourself room. A 30-year with aggressive voluntary overpayments gives you the forced savings when things are good and the flexibility premium when things are not. Step 3 is to make the gap automatic and invisible. If you choose the 30-year, the Invest the Gap plan only works if the money never hits your checking account. On day 1, set up an automatic transfer for $810 into an index fund. It goes out the same day your mortgage payment clears. You have to make the discipline structural, not aspirational. If you are relying on willpower every month, the lifestyle will eventually win. The system has to do the work. Here is the Freedom Reframe. The 15-year mortgage promises you ownership sooner. That is real. But what it actually buys you is a lower floor of future obligation. The 30-year mortgage managed intentionally does not buy you less freedom. It buys you more options while you get there. The question is not which mortgage saves you more interest. The question is which one gives you the kind of control you will actually use. Interest savings on paper do not matter if the higher payment triggers a crisis the first time your income dips. And a flexible mortgage does not help you if the flexibility just quietly funds a nicer car and a few extra vacations over 30 years. Henry made his call. He chose the 30-year. He set up the automatic transfer before he left the closing table. Whether that was the right call depends on whether the transfer is still running in year 12. That is the only thing that matters. I want to hear from you in the comments. Drop your honest answer. If you had the $10 gap every month, would you actually invest it or would it disappear into your life? No judgment, just honest data. If you are working through this decision right now and you want more of this kind of math, hit subscribe. We publish one of these every week on Salary to Strategy. I am Andre, and I will see you in the next one.